Picture a nuclear explosion, except the smoke is copper coins and copper wires. That's today's nuclear number, $13,000 per ton. Copper sounds ordinary until you realize it's the metal that makes electricity move and modern life function. In 12 months, copper didn't just rise, it rocketed, up about 53%. Investors are hanging on like, don't leave me. But the real point isn't trading hype. When a basic ingredient moves like a rocket, the shockwave spreads into prices, profits, and your wallet. Take your iPhone. Inside is roughly $8 to $10 of copper, tiny per phone. But multiply by millions of units, and that tiny becomes real money. When copper jumps, companies either absorb the cost, lower profit, or pass it on, higher prices. Now the invisible victim, the EV buyer. A Tesla Model 3 uses about 83 kilograms of copper. When copper gets pricey, it's like a giant invisible hand labeled copper inflation reaching into your wallet, quietly taking money before you even drive away. So why does one metal matter? Macro 101. Prices are signals. Economist Friedrich Hayek said prices spread information fast. When copper spikes, it's like the price gear starts glowing and ringing, telling households, companies, and markets something is out of balance. That signal triggers a quiet money shift. Manufacturers and consumers get squeezed, while parts of the supply chain upstream can benefit. No one sends you a copper tax bill. You feel it as thinner margins, delayed projects, or higher prices. Little leaks that add up. Here's the hidden twist. It's not only about mines. The drama often sits in the middle, smelters and refiners. Because ore isn't what your phone or car uses, the economy runs on refined copper. And if that middle step tightens, everything downstream feels it. Think of refining as a narrow bridge. You can have ore on one side and demand on the other. But the bridge limits flow. When that bridge gets crowded, buyers compete harder and prices jump. This bottleneck is why copper can spike even when there's plenty in the ground. Quick model. Step 1. Mine ore. Step 2. Refine it into usable copper. Step 3. Turn it into wires, motors, and electronics. If Step 2 slows, Step 3 starves. So to understand copper prices, you don't just watch mines, you watch the middle step. This funnel is the whole story. Ore pours in, but refined copper drips out. Smelters are like kitchens. If they can't run profitably, they slow down or shut for maintenance. That's how plenty of ore can still become not enough copper. Bottlenecks turn small issues into big price moves. Now a metaphor. Imagine a bakery with fresh bread. When bread is scarce, people don't wait. They line up and rush to buy now. That feeling, urgency and competition, is exactly what a physical shortage looks like. And copper can behave the same way. Here's real life. A contractor quotes your rewiring using today's copper price. If copper jumps, the quote rises or the job delays. Companies face the same choices: raise prices, cut features, or accept lower profit. That's why commodity spikes can quietly slow the economy, one invoice at a time. And now the human trap. The crowd climbs the mountain, cheering, up forever, while smart money quietly steps down. Daniel Kahneman showed how we chase recent wins and copy the herd. Headlines feel like proof, but in cycles, peak excitement is often peak danger. Prices stretch like a rubber band. The more they stretch, the harder they can snap back. That's why Jim Rogers warns commodities can surge fast and crash fast. Your goal isn't to predict perfectly. Your goal is to survive volatility with rules, not emotions. One market idea made simple. If bread costs more today than next month, people rush to buy now. That's backwardation. In plain English, we need it now and supply feels tight. Your brain already understands it. No charts required. Now the opposite. If the warehouse is full and bread is expected to cost more later, nobody panic buys today. That's Contango. In plain English, we've got supply, but storage costs money. Same bakery, different mood. Easy to remember. So why should investors care? Second-order effects. When copper stays high, big projects feel it. Construction, EV supply chains, and data centers. First comes a higher cost, then delays. And markets don't just price outcomes, they price timing. Late reality can shock earnings stories. That's how a metal headline can become a tech headline. Modern infrastructure is copper-heavy. When timelines slip, forecasts change. And when expectations are high, even small delays can cause big market reactions. The key is seeing the chain before the crowd does. Keep 3 voices in your head. Hayek, prices are signals. Jim Rogers with the bow tie, commodities swing hard. Warren Buffett with a Coke, discipline beats excitement. You don't need to be a copper expert. You need simple rules when the crowd gets loud. If these whiteboard stories help you stay calm in chaotic markets, subscribe to Sketching Finance. We turn expert finance into beginner-friendly visuals so you can understand headlines fast without getting overwhelmed. Now, the action plan. Defense, offense, skill. Defense comes first because if a surprise drop wipes you out, you can't take advantage of opportunities later. Think of defense as staying in the game long enough to win. Defense for beginners. Use 3 buckets. Safety, cash or short-term bonds. Growth, a broad index fund. Opportunities, small themed bets kept modest. Then rebalance sometimes. Trim what grew too big, add to what shrank. It quietly forces buy low, sell high without stress. Offense is selective. When copper is strong, some producers can benefit, while heavy copper users may struggle. You don't need to go all in. Small, thoughtful exposure can be enough, so you participate if the trend continues, but you're safe if the cycle turns. Skill is the rules. 2 rules beat 10 opinions: position size and an exit plan. The size is small enough to sleep. Decide ahead of time when you'll reduce risk. That's how you avoid becoming the person cheering at the top of the mountain. Quick recap. Copper's nuclear number is $13,000 per ton. The invisible victim is everyday buyers because copper quietly pulls money from your wallet. And the hidden engine is the bottleneck. When refining tightens, urgency spikes, and prices react. Number, victim, bottleneck. Next video, we shift from copper to power, the Fed's succession earthquake, when the Fed chair seat is worth $10 trillion in market expectations. If you want that story broken down with simple visuals, subscribe to Sketching Finance and turn on notifications. You'll see markets differently before the crowd does.